Hello, in today's video I will be talking about Kamala Harris's tax proposals, specifically and exclusively about capital gains tax. I'll try to be as unbiased as I possibly can, so only talk about current law versus what is proposed. Hello, what are you doing here? I came here to help you. You need to make this video unbiased, so I'll make sure of it. Go ahead, tell everyone about unrealized income. It's a hot topic nowadays. Okay. Under the current law, long-term capital gains and qualified dividends are taxed at graduated tax rates based on taxable income, where 20% being the highest rate. If you take into account the net investment income tax, which applies to taxpayers whose AGI is over a certain threshold, that gives you 23.8% at most. In addition, only realized capital gains are taxed, which means that you have to sell or dispose of the property before you pay any tax. Do you know the new tax proposal that relates specifically to realized capital gains? Yes, I do. They want to make it flat 28% for all taxpayers with AGI over $1 million. Or $500,000 for merit filing separate. Exactly. Do you know if they want to keep the net investment income tax of 3.8%? They don't mention it at all. I doubt they even know it exists. Who are they? You know who I'm talking about. On a similar vein, the new proposal would impose a minimum billionaire tax of 25% on all income, which would include unrealized capital gains for all taxpayers whose net worth is over $100 million. Wait, I thought you said a billionaire tax. Did you misspeak? No, the tax is kindly proposed for every individual who is worth more than $100 million. But it's called the billionaire tax. So what? They forgot a zero. Are you gonna make a big deal out of it? But 1 billion versus 100 million is... only by an order of magnitude. I kind of think it's a lot. Practically the same. I mean, they're all rich enough to pay the billionaire tax. Why are you making such a big deal out of this? It's not important for this video who pays the tax, so don't fuss about that. What's important for this video is how the tax is calculated, which, to be honest, is a little bit ridiculous. Well, the way you calculate it, I assume you find the difference between adjusted basis and fair market value and multiply by 25%? Well, the tax proposal doesn't quite specify whether you should take adjusted basis or merely cost. Would you explain what adjusted basis is for our viewers? Basis is the same as cost, what you purchase the assets for. Adjusted basis is cost adjusted for certain items such as depreciation, improvements, etc. So, if you bought rental real estate in 2004, let's say for $5 million, and now it's worth $20 million, the unrealized gain would be $15 million multiplied by 25%, resulting in $3.75 million of tax liability. Well, the $5 million basis may need to be adjusted for depreciation and improvements if you had any, though, as I said, the proposal is unclear, so I don't really know. How will the taxpayers find the money to pay such a high tax out of the blue? I mean, they're all rich, right? So they should have the money to pay it. After all, this tax is only imposed on billionaires who are worth at least $100 million. It seems to me you're confusing billionaires with millionaires. Anyway, when you say $100 million worth, do you mean at cost or at fair market value? Well, net worth is equal to assets minus liabilities, and since these two things are found on a balance sheet, and since the balance sheet is usually prepared on cost basis, I would venture to say it's $100 million at cost. Though, again, I don't really know. That's preposterous. Don't worry, the government is magnanimous enough to realize it may be difficult to come up with so much cash outright to pay the tax bill. Well, what the government needs to understand is that if a person is worth $100 million per cost, and then all of a sudden they need to pay unrealized gains tax, and let's say, just for an example, they're now worth $400 million at fair market value, so their unrealized gain is $300 million multiplied by 25%. That's $75 million of tax liability out of nothing. Yeah, it's magic, right? What's so magnanimous about that?
Well,
for the first year of this billionaire minimum tax, there would be an election to pay it over 9 equal annual installments. So, from my example, the individual would take $75 million, divide by 9 years, which produces approximately $8.33 million that they would have to pay each year for 9 years.
yeah, manageable, right?
Except that for the following years, if you have this billionaire minimum tax, the period of time would be reduced to 5 annual equal installments. I wonder if the government would charge interest for such a kind gesture. They might, but I don't want to mislead anyone, so I'll just say, I don't know.
What about fair market value?
What?
How do you derive that?
Well, that's easy. If you have tradable assets such as stocks and bonds that are traded on the open market, all you need to do is look them up.
But what if you own stocks of privately held corporations, interest in partnerships and S corporations, or businesses such as single-owned LLCs, or real estate, or even things such as collectibles, works of art, trade names, trade secrets, franchises? You know what I mean. How do you find the fair market value of non-tradable assets? Do you have to do appraisals every single year or market valuations or what?
No, the government will tell you.
What? Will the government come and issue me a letter with fair market value?
Oh, stop with the nonsense. Non-tradable assets value will increase annually by a conservative floating rate of return, which is
5-year treasury rate plus 2 percentage points.
exactly. And that's in between valuations. And by the way, the IRS may offer certain avenues for taxpayers to dispute such valuations, for example, with an appraisal. And it actually brings me to another important point. If a taxpayer is worth over 200 million, they would need to report annually with the IRS the total cost and estimated value of all of their assets and liabilities separated by class.
What about unrealized losses?
Unrealized losses? What are those?
You know, when assets lose their value instead of gain it. It can happen if a natural disaster strikes and your real estate loses its roof, or if you lose all of your tenants and your building stays deserted or becomes infested with rats and spiders.
Oh, come on, this never happens.
There is nothing on unrealized losses, not a word on how those would be treated?
No, not to my knowledge.
Well, maybe our viewers would know. Comment if you do.
No, we don't want to see any comments under this video, which shouldn't be a problem. Comments under my videos are non-existent, just like the concept of unrealized losses in the brilliant minds of those who put this tax proposal together. On a serious note, this report with the IRS that needs to be filed every year would be very important to determine which taxpayers would be eligible to be treated as illiquid.
For what?
Well, you see, illiquid taxpayers would be able to include unrealized gains of only the tradable assets in the calculation of this tax and disregard any fluctuations in the value for non-tradable assets. However, it does come with a string called a charge, which is really a fee or a fine. It's a penalty, all right? And the penalty would apply if the taxpayer eventually sells the non-tradable asset and realizes a gain. And the good news is that the penalty will never exceed 10% of unrealized gains.
Not sure I fully understand.
To be brutally honest, neither do I.
Okay, so who would be an illiquid taxpayer?
If tradable assets held both directly and indirectly do not exceed 20% of the total wealth of the taxpayer, that would be an illiquid taxpayer. I think it was made specifically so that billionaires don't start selling their non-tradable assets immediately.
What difference would that make? People will start selling their tradable assets to come up with the cash.
Well, that may be the entire point, I think, aside from raising more tax revenues, obviously.
But who would be buying those assets then?
Who cares? The good news is that there would be no mandatory estimated tax payments made in connection with this billionaire tax.
So, if a taxpayer eventually sells its asset at the true fair market value, what next? Do they have to calculate the realized capital gain and pay tax on it again?
The payments toward this billionaire minimum tax are really treated as prepayments toward realized gains. So those would be credited. This way, the same amount of gain would not be taxed more than once. This would be very difficult to enforce, and imagine the amount of tax disputes this would cause and the amount of bureaucracy, as if there isn't enough of it already. Tread carefully. Not everyone would agree with you that there is enough bureaucracy in the world already.
It smells like 1980. I mean, it smells like a...
I don't smell anything except for good perfume on me.
There is a lot more that Harris proposed in her tax plan.
Yeah, I'm afraid we won't have enough time to discuss those. Maybe leave for another video.
Do you think we managed to make this video unbiased?
I do. We only talked about the facts that are available to us, which is not many.
Yes, and we didn't even cite or talk about what economists and financial analysts think about the specific unrealized gains tax and how this would affect the economy of the US, the world, and the universe itself.
And we won't.
There is a little modest theory which states that if ever anyone discovers exactly what the universe is for and why it's here, it will immediately disappear and be replaced with something even more bizarre and inexplicable. And there is another one which says this has already happened. Where did you get that from?
I'll put a citation in the description of this video, and if our viewers know where it comes from, feel free to share it in the comments.
But I thought you didn't want any comments.
Don't worry, there will be none. I can almost guarantee you that. Thanks for watching.